Well, what a few days it's been for the financial markets. The bankruptcy of Silicon Valley Bank over in the States, sending volatility soaring higher across the board. Bonds have rallied hard. The 2-year Treasury at one point down around about 100 basis points in just 3 days as a dovish Fed repricing kicks in and the market pulls a bit of a U-turn on its policy outlook. The dollar has faced headwinds as a result. The yen has found haven demand, while stocks, they've been all over the place, but the bears seem to be in control of things for now. It's an absolutely huge week coming up for the markets. The fallout from the SVB bankruptcy will certainly continue, but it's a week laden with tier one event risk as well. We've got the latest US inflation figures out. We've got a policy decision due from the ECB over in Frankfurt, and of course, the budget here in the UK. There is a ton for Ryan Littlestone and I to discuss in the trade-off this week. So without further ado, let's get into things. Well, as I said, markets are incredibly volatile at the moment, so unfortunately no time for football banter this week. We'll bring Ryan in straight away, Ryan Littlestone from Forex Flow Live and Forex Analytics. How are you doing, mate?
Yeah, hi Michael, how are you doing? Busy old day to kick off the week, isn't it? I think we need a big fat disclaimer put on this video that anything we post and show today is probably out of date by about 200-300 pips either way.
Yes, exactly that. It's Monday, 2 p.m. here in London. So anything that we say, please take it in that context. Don't go clipping this up and making us look like complete muppets on Twitter if we say something that turns out to be totally different by the time this video comes out. One thing I think we can be sure of, though, is our calls are probably going to age better than those of a certain commentator on CNBC. With that said and done, let's get into Topical Thunder. Well, I think there's really only one place we can start this week, and that is with the collapse of Silicon Valley Bank, SVB, over in the United States. Just to give everyone a bit of a kind of rundown on exactly what's happened there, SVB were a very heavily tech and VC-focused bank. Their risk management practices look quite subpar at this point, to be honest with you, given the outcome that we've seen. They had a lot of their balance sheet held in fixed, low-yielding securities, which meant that obviously as rates have risen and deposits have been pulled out of the bank, their book has ended up quite significantly underwater. And then the sort of cardinal error that they committed was they said they were going to source new capital and replace the low-yielding securities with this new equity capital, but they decided to sell that securities portfolio first before securing any new capital, at which point everyone went, absolutely no chance, don't want to touch you with a barge pole, and ran an absolute mile. And of course, on Friday, we got the news that the bank had collapsed, and that's been followed by Signature Bank also being put into an insolvency procedure, and First Republic look like they may be following suit. The Fed put has made a bit of a return. The Fed announcing on Sunday night, don't we all absolutely love Sunday night Fed announcements, just as we're about to curl up and go to sleep, that a new liquidity facility is being put in place. That's going to buy bonds at par from banks that are experiencing liquidity issues, and the FDIC and the Treasury guaranteeing all depositors at SVB. Ryan, what I'm really keen to get your thoughts on is where we go next. Obviously, the market, as the Fed news broke on Sunday night, risk assets ripped higher. The dollar faced headwinds. The dollar's still facing headwinds. Risk has soured as we've gone through the Monday session. Treasuries are rallying hard. The 2-year down 50 basis points below 4%. The market is saying that this is not enough, that what the Fed have done is not enough, that this is a bigger issue than policymakers are making it out to be, and that it could even spell the end of the rate hike cycle and potentially even rate cuts. Personally, I think that's probably a little bit overdone, and we're just seeing panic set in at this point. What are your thoughts on that one?
Yeah, where do you start with this one, eh? Yeah,
I've got into the show this week, mate.
I mean, last night, I was following the headlines, and the Fed were jumping out, the Treasury were jumping out, all these backstops coming into play, and the market liked it. Risk was buoyant. S&P opened in futures higher. FX wasn't doing an awful lot. Everything looked tickety-boo, and then we come in this morning, and the pre-market in the US is just a bloodbath in the banking sector again. And I think what's happened is that we've got a bit of a split. yes, the US authorities have backstopped depositors, but shareholders, bondholders, they're still left holding the can. They're not going to get anything back likely from SVB. They won't likely get back from any of the other regional banks should they go pop as well, like Signature. So there's a natural get out of Dodge trade going on here at the moment. So it's twofold what we may see here. We're seeing the market trading that side of things and the possible contagion, even though I don't think there is any contagion to come. And we may see some of those bank runs hitting banks today as well. But because they are protected now, there's less reason for anyone to go run into a bank to say, I'm going to lose all my money. I need to stick it under the mattress. So I think we're going to need to see a couple of days of what more the Fed or the Treasury come out and say or do if they feel like they need to do. And then see how we're progressing. If there's no more skeletons coming out of the closet on this, no more banks going pop, I think we calm down. I think the market calms down and we get back to trading everything else.
Yeah, no, I would agree with that. I think it's going to be key to see how the news flow develops if anyone else does start to follow suit. I mean, SVB on their own, you wouldn't think they're going to be a systemic issue. If we see 3 or 4 of the regional banks go and, that continues over a number of days, then that starts to become a bigger problem. But I'm with you on that one. I think if all of this does settle down, if this is kind of it, then this will blow through and we can get back to trading on the macro side of things and almost go back to where we were. And of course, one of the big things we got this week is the US inflation print that has been somewhat overshadowed, but deserves our attention nonetheless.
Yeah, definitely. We got the big inflation numbers, and if it wasn't for this bank stuff, this is probably what we'd all be talking about this week. What's going to happen with inflation. We're expecting inflation to drop down, the headline number to drop down to 6% from 6.4%. And that all-important core number is expected to come off a pip to 5.5 from 5.6% as well. Now, we've had this cat among the pigeons with the last PCE report, obviously. The core number there actually rising. And a lot of people saying, maybe this is the bottom for the drop in inflation. We've had the peak, now we've had the dip, and inflation's going to be rising again. So the market is going to be looking at this one, obviously, for the impact from the Fed, and we're going to talk about that in a moment as well. But the data is going to be important, and the reaction to the data is going to be very important. I think if this flips and we see inflation not falling perhaps as much as expected or even rising, it's going to change up these Fed expectations that Powell laid last week before all this mess. And I bet he's glad he didn't have this banking stuff to deal with through those testimonies.
I was going to say that Humphrey Hawkins testimony feels like about a lifetime ago at this point, doesn't it? But it's interesting that you raised that point, because obviously the last CPI number that we had out, that came in hotter than expected. I think it was 6.4 against a forecast of 6.2. So there is good reason to expect that risks to this print are also tilted to the upside. And of course, we've had that hotter than expected PCE number in the mix as well. I think you're right. I mean, I think obviously policy expectations are absolutely all over the place at the moment, given what we're seeing take place with SVB. Personally, I think a 50 basis point hike was never really a serious option for the Fed. I couldn't see them going down to 25 in February and then speeding things up again come the March meeting. But I do think that the inflation data is going to emphasize once more and evidence the problem that the Fed have got, in that inflation is not coming down in anywhere near as quick a manner as they would like to see. And financial stability concerns or not, and I don't think there's huge ones there at the moment, you're still dealing with an economy with 6% inflation, north of 6% inflation, and very, very bumpy disinflation. And in that sort of an environment, I think we're going to see the Fed continue to hike probably well into the summer, and the market's going to end up having to do yet another U-turn on its rate expectations.
Yeah, absolutely. And, the data is going to continue to come thick and fast. You want to highlight the US jobs report. So, I'll punt that back over to you. You can let us know what happened in that Goldilocks report last week.
Yeah, Goldilocks-ish, I think I'll call it. I don't want to call it a total Goldilocks report, but the jobs number was pretty solid. I mean, the US economy added, 311,000 jobs in the month of February, whatever month the jobs report was for. Unemployment did tick slightly higher to 3.6%, but That's not a concern, because actually, if you dig into the report, the reason the unemployment rate rose is because participation rose. So more people coming back into the labour force, participation up to 62.5%. So that's actually a positive. And then the other part of that jobs number that we had come in solid was the fact that average hourly earnings, they rose by 0.2% on a monthly basis, which is a decent pace. It's a healthy enough clip, but it's not a pace that's going to worry policymakers around what we call second round inflation effects, this kind of wage price spiral that people have started to talk about. But I think the big question for me, and obviously this has all been overshadowed since by the SVB shenanigans, and in fact they were going on while the payrolls report dropped, so we didn't get a real kind of clear idea of how the market interpreted that data. We've had 517, it was revised down to 504 jobs added in January. We've had another 300,000 jobs added to the US economy in February. That's 800,000 jobs added in 2 months in an economy that is relatively late in the cycle. You've got people still with recession calls out there. How long can the US economy actually sustain this kind of pace of jobs growth? Because to me, this is not although unemployment is rising, although average hourly earnings aren't overheating, the US economy can't sustain this pace for much longer, I wouldn't have thought.
No, but then we've been asking that question for, how many months? The sword of Damocles has been hanging over the jobs market. Everyone's waiting for that moment for it to turn, and it doesn't, and it hasn't. And, how long do we want to wait for that to happen, and particularly trade that way for that to happen? But you're right, 800,000 jobs over 2 months, to call it an average of 400,000 a month. That's well above what we've been seeing last year, running sort of 200, 250, 270 as a sort of average. And we can't break that at the moment. Now, are we seeing problems? We've seen a bit of weakness in some of the sectors, like the manufacturing side of things, and the payrolls number in there actually fell by, I think it was 4,000. Pretty much along what we've seen in the PMIs on the jobs front. But this again is coming into this soft landing, no landing type scenario. So if you strip out what's happening in the bank stuff at the moment, you've got to look at the fundamentals, and they're still the same as they were last week. Nothing has really changed in that aspect. And on that basis, you've got to think that the Fed's going to continue on its path, aside from dealing with the fallout from this banking stuff.
No, I would completely agree. And I think just on that, I think it's interesting to draw a distinction between what the Fed would see as, and this, if you're not interested in the geekiness of monetary policy, skip the next 30 seconds. The Fed will want to draw a distinction, I think, between what they see as their financial stability remit and their monetary policy remit. I don't think, and we're not going to hear from him, I don't think, because it's the blackout period, but I don't think Chair Powell is going to want to conflate a new liquidity facility to keep regional banks in business with any sort of monetary policy action at any time, particularly when inflation is running north of 6%. But what are your thoughts on the Fed meeting, obviously 22nd of March?
Yeah, well, obviously last week we had a big ramping up in expectations. The market's starting to price 50s. I mean, all those banks who are putting their 50s out the hat for expectations and hiking for longer, and 50s in May and June and everything, they've gone into complete reverse now. They've just... It's disappeared in a puff of smoke, half of these expectations. We're back to pricing cuts. There's some even saying we might get a cut as early as June or July or something. It's all flipped on its head. But I think if you take the sensible approach, I think the 50 is definitely off the table now. I think the 25 is cemented in, particularly because of all these issues. Is there a risk that the Fed might not hike at all? I think if they don't hike, it will be very much tied to financial stability issues. It won't be anything to do with the economy. It'll be to get over this hump that we've got with this banking problem. And we're going to know that if, as we said, we get further problems coming from this sector over the next couple of days. So I think it's a 25 is still nailed on. I don't think particularly they're going to take a dovish slant to this in terms of the fundamentals. Again, they may do because of the financial stability risks that are in play. They will want to make sure, as you said, the message gets across. They've got this covered. They're in control. They will do what they need to do to get through this mess. So it's trying to play two trades at once. You're playing the banking crisis side of it, and you're playing the fundamental side of it. The fundamentals still solid, CPI still high, jobs still high. There's no reason for the Fed to change their path as of now.
No, I would totally agree with everything you said there. I would just add a couple of things. One is, I think actually in times like this, Fed pricing can be a really useful gauge of whether the market is going over the top or not in terms of its reaction to events like this. I mean, we were talking before we hit record on this show. The market's pricing a 75% chance that the Fed cut rates in July. Now, I don't want to be held hostage to the future here, but I don't think there's much chance of that happening, if at all, particularly, as you said, given that the underlying fundamentals of the economy remain strong. Now, I think that's just a good way to gauge, have we gone too far, too fast in pricing in a kind of Armageddon scenario? And if we have, which I think we have, then do you start to go and look at actually are riskier assets looking a little bit more constructive? Do you start to nibble long into some of the indices, for instance? I think the other thing is, it's going to be very interesting how the sell side calls this. I think Goldman have already said that they expect the Fed to remain unchanged at the March meeting. Be interested to see if more and more people join that club, because as we know, the Fed do have a bit of a tendency to be pushed into things by what the market's pricing and by what the sell side are saying. And I think if we do see a few more of these respected tier one banks going for an unchanged call at the March meeting, then we could indeed see the Fed go for that. That's certainly not my base case at the moment. And just the last point I would make is, because we've seen this significant dovish repricing of policy expectations, the market, I think there's two things to note. One is that bonds are just running away with themselves to the upside and yields to the downside, of course, because you've got haven demand coming in and you've also got everyone betting on a more dovish policy stance. But the other thing is actually the dollar is not behaving as you'd expect it to. In times of market stress, generally what do you want? You want cash dollars. Well, not now, because the 2-year Treasury, as I said in the show intro, is down 100 basis points in 3 days. So everyone is asking themselves, why do I want to hold dollars in that sort of an environment? Therefore, currencies like the yen and currencies like the Swiss franc are actually showing their sort of safe haven credentials a little bit more than you would perhaps expect in times like this. But with that said and done, let's move on to that's a setup and dig into some of the charts in play. So, plenty for us to get into. I want to look at dollar yen first of all, and again, the same caveats that we mentioned in the show intro apply. God knows where the market's going to be when you look at this, but hopefully we can put some levels out there to have on the radar. This was obviously my play of the day last week, and I was texting Ryan during the week. I was very, very nervous on Tuesday when Fed Chair Powell sat down in Congress and started talking about a 50 basis point hike, and we blew through the 200-day moving average, which I'd flagged as a huge resistance level. I'm not going to take a victory lap because I would have got out of the trade at that point if I was putting this on. But nevertheless, 137, 137.50 has held once more as an important resistance level for dollar yen. And we've seen a pretty significant reversal since then. Obviously, falling yields and this dovish repricing that we've been talking about, a massive help and the major catalyst here. I think the market is quite clearly, and I think we've probably tested now the 50-day moving average to the downside, which is around 132.50. So obviously things are going to get really interesting if that gives way. Do we start to look for 130? But although I'm actually bearish dollar yen at the moment, I think this has probably gone a long way in a short space of time. And I think for me, at least, the move in the Treasury market is probably overextended. And we'll get onto that in a second, I'm sure. And as a result, I would actually, very, very small position, very, very tight stop, be looking to start leaning against this move and actually long dollar yen back towards that resistance around 134.50 to start with, at the very least, is starting to look a little bit more attractive, just given how far we've moved in such a short space of time.
Yeah, I think you're spot on with that. We have come a long way. We have dipped quite significantly on all this news. And again, if you take it from the fundamental perspective, the US economy is still strong. The Bank of Japan is still easing and not looking to change as of yet. So, you know, there's every reason to see this go higher if things improve with this banking stuff. So I'm in the same boat as you. I'm going to be looking for any decent dips here. Pick your levels. If you want to fight these moves, you've got to be careful and take the volatility into account. Don't trust the text as much as you would normally, because one headline and they blow through. But yeah, if you want to fight this is one of the pairs you maybe want to look at, but keep it small, keep it tight, and keep in control of it.
I think don't fight the text works for social media as well. I was winding up the Elliott Wave folk earlier, and I've been getting an earful ever since. So that will teach me. What about the Treasury market, Ryan?
Yeah, well, this is what I wanted to highlight. Coming into a quiet week before the proverbial poo hit the fan. And it was really
I was taking a glass of water, didn't you?
Yeah, nearly made you spit it across the screen. But I wanted to show this because what we actually saw last week after Powell was an acceleration in yields, but it all came at the short end, all came at the front end in like, you know, from the shorter durations, the 3 months, 6 months, 1 year, 2 year end, rather than the longer durations. So we've seen a bit of an acceleration, a bit of a gap, and the chart you can see here, you know, goes back to last year where, you know, 1 years, 2 years were trading well below the 10s and 30s, and how that switched around for the short end to move above, and it's accelerated further, particularly on Powell. And what that says to me is that the market is obviously, or was obviously last week, buying into the narrative from Powell. Yes, they're going to keep fighting. 50s might be on the table. They're going to get rates up higher for longer. But the lack of movement in 10-year yield, for example, that paints a different picture, because we couldn't get above 4% and hold above there. We came down under it pretty quickly. And that says to me, right, the market is saying, okay, fine, you're going to take rates up to 5.5%, maybe even 6% really, really quickly, but you're not going to stay there for long. And you're going to stay there far shorter than if you were taking it to 5.5, and then keeping rates up there. So this pricing is showing again that there's going to be a quick reverse, if you like, in expectations of when the Fed cut back rates to wherever they see neutral as, maybe 2.5-3%. And that we need to be aware of, because it's going to mean that rather than the market saying, yeah, we're happy with the Fed getting rates up and then sailing along like this, we're going to see it go like that. And that's going to bring a big reversal in some of these yields. Obviously, today's a whole different kettle of fish because these yields are blown out the water anyway. But the premise still stands. If we get over this banking situation, the market goes back to properly pricing the Fed, we're going to need to watch the short end over the longer end.
No, I think you're absolutely right. Sorry, I was slightly distracted by Bloomberg while you were speaking, because two bits. One, regional banking shares are going through the floor again, and two, NatWest and PIMCO are now both calling for the Fed to remain unchanged in March as well. So it does seem like a bit of a growing chorus on the sell side for that one. I do think, though, actually, just on that, the risk reward here to fade some of the moves we've seen in the bond market and to fade some of this dovish repricing, if you do think the Fed are going to stick with their higher for longer, we're going to continue hiking until inflation is under control narrative, which I do think they're going to stick with, I think the risk reward on that is looking pretty attractive at this point in time. But let's have a look at crude. I want to look at WTI. I know you picked this out either last week or the week before. We've obviously been in a range for quite some time. I think since sort of Q4 of last year, we've been stuck between 72 and 82, roughly $82.50 a barrel. But what's interesting is if you zoom out a little bit from your 1 minute and your tick charts that people like to look at a daily chart, zoom out, take a longer term view. We're actually making a series of higher lows, but at the same time, we're making a series of lower highs. And we're ending up in this narrowing wedge formation that I've put in red here on the chart. And that means that ultimately a decision is looming relatively soon. The market has got to decide, does it want to break out of this wedge to the upside, or does it want to break out to the downside? And I think the reason why I like this setup so much at the moment is because pretty much bang in the middle of this wedge, you've got the 50-day moving average, which helps us to assess which way the balance of probabilities tilts. And it's a very similar chart if you want to pull up Brent and trade that blend of crude instead. So I think all the time we're below the 50-day moving average. Obviously, you would say that downside is the more likely direction of travel, and vice versa if we manage to flip above that pink line on the chart. If we were to break below the bottom of the wedge, then you'd look to around $74 a barrel before obviously 72 at the bottom of the range. To the upside, you've got $80, which is roughly the wedge there, and then $82.50, which is the top of the range we've been in since Q4. And of course, the other thing with oil is, if you don't want to trade oil itself, there are plenty of proxies through which you can get exposure to it. It's also a currency play. If we were to see Brent and WTI break to the upside, you'd look for strength in the Norwegian kroner and the Canadian dollar, those sort of currencies, a commodity dependent block, and vice versa if we were to see Brent break to the downside and WTI as well. So this isn't a chart that I'm looking to act on right now, but it's something that I think certainly worth having on the radar, because if we can pull further away to the downside from the 50-day, or we can make a closing break above it, then there are some interesting levels that should definitely be on traders' minds, I think. And I know this is something you've been watching pretty closely anyway, right?
Yeah, in previous shows, I was looking for perhaps a move to that 82.50 for a short. It's funny how different people see different pictures on the charts. You've got a wedge there. I've got more of a box between these lows in the sort of 72s, 30s, 40s, and that 82.50. So I'm playing it more of a horizontal technical box, if you like. And we couldn't quite get up to that 82.50. We failed at 80.50, which again is another bit of resistance just ahead of that. And you know, I see that lilac line you got there, 72, 73, as the more important line for me. That's a solid double bottom, and we need to get a move below there, which will get us down towards that 70 area, the famous bid and bid line, as we're calling it, where he's likely to step in and start stocking back up the oil reserves. But it's surprising that we're staying in this consolidation for so long, because that doesn't tend to happen so much with oil. And if we do get a break either side, it's likely to be volatile.
No, most certainly. Well, what about your last chart, euro dollar? It's I think we're 27 minutes into the show, and we haven't mentioned the fact that there's an ECB meeting yet this week.
Yes, that little old bank of the ECB, who might actually come out of this unscathed, because for once
they're not going to go bankrupt, are they?
Well, it doesn't look like for once they're actually going to have much exposure to what's going on in this banking business. Usually, if something's happening in the US, you'd expect it to be twice as bad in Europe. And, you know, we know from history the banking crisis 2012 and all that, what a mess the Eurozone can get into. But by and large, they're looking okay. So I'm looking at euro dollar because I've been watching it over, you know, since last night, since Friday, and obviously today. And it's really keeping to a tight range, and it's not got the risk volatility in it that some of the other pairs have got. I mean, if you look at dollar MEX, it's sailed up above 19 today, where it couldn't get above 18.20, 18.50 for ages. So this one, if you're looking for pairs to trade over this volatility, euro dollar isn't showing a lot of volatility at the moment. We're in this another box between 107 and 105. I'm still itching to get a trade off that 105, all being well with the news. But we've seen moves above 107. It's just not holding. So I think what you got to look at here is maybe if the market gets a bit dovish on the ECB with all this banking stuff going on, that may be a dip if we get one in the euro dollar, maybe down to the 105s. Something to look at into the ECB perhaps, because I don't think they're going to change their stance at all. And if the market's expecting them to and they don't, we're going to see a reaction to the upside here.
Yeah, I would agree with that. I think the ECB meeting has actually, and I don't use this word often to describe the ECB, I think it's actually got more interesting since the SVB collapse over in the States, because, as you say, Europe is not especially exposed to what's going on. SVB didn't have a huge operation in Europe, if any real presence at all. And of course, nor do any of the other regional US banks. There's a reason why they're called regional banks. So this dovish repricing that we've seen of the Fed curve, we've seen it also of the BOE and of the ECB. But at the same time, I don't think this is going to have anything like the ramifications for the ECB that it may do for the Fed. So the market's pared back its expectations for the ECB, now pricing in just a 25 basis point hike. I think they're still going to go 50. I think they're going to be hawkish. I think they're going to signal that hikes will continue probably until the end of the spring at a 25 basis point clip. Let me clarify that after this meeting. And as a result of that, the market is going to have to reprice the curve. And if we do see that, then I think risks are probably at this moment in time tilted to the upside for the euro, purely because of this repricing of expectations that we've seen, which is just incompatible with the rhetoric that we're seeing from the ECB, but also the data that we're getting out of Europe. Core inflation is at 5.6%. It's an all-time high. How can the ECB become dovish in that environment when core inflation shows absolutely no sign of peaking anytime soon?
Yeah, I agree with that 100%. And, like the Fed, if the market's ruling out ECB hiking in, further down the line, I think I've got more chance of turning up with a ponytail next week than that happening. So, the Fed, the ECB are going to continue on their path. They're going to talk about the risks, definitely. But as I say, for this pair, euro dollar, it's not got the volatility in it at the moment that we're seeing in other pairs. And if you want to get you away from that volatility, these are the sorts of things you got to look at.
If anyone watching this is good at Photoshop, please, for next week, send me a photo of Ryan with a ponytail. With that said and done, let's get into our plays of the day. So, play of the day, for me, I want to look at the Treasury Curve. The market is ridiculously volatile, and I've chosen to put on a quite complicated trade because I like to make things difficult for myself. As I've said a few times throughout the show, I think the move that we've seen, particularly in bonds, has gone too far too fast. It's got all the hallmarks of panic about it. And to be quite honest with you, it is not justified by either the economic fundamentals or what the Fed are likely to do. I think the key thing for me is twofold. One is the Fed trying to separate financial stability and monetary policy. And secondly, this is a bit more technical, but the liquidity facility, they're going to buy bonds at par. So the bonds they're buying are not going to be affected by any moves in interest rates that they may choose to take over the coming months. And I think that is going to allow them to continue raising rates. Obviously, we've got the latest CPI numbers out on Tuesday. If we do get a hot print, then you're going to see yields move higher across the curve. You're going to see the market pull another U-turn. I think what we've seen is, frankly, as I said, a move that's overextended. The curve has steepened to a ridiculous degree over the last 3 days. 2 years have come off 100 basis points. 10 years have come off 60, 70 basis points. I think for me, I would look to start leaning against these moves, more so at the front end of the curve. I'd be looking to get short of the 2-year Treasury, and as a result, expecting the curve to flatten and almost go back to how we were. Once this whole thing blows through, once markets realize contagion risk is much lower, once we focus back on what's going on with the US economy, I would expect yields to be considerably higher and the curve to be considerably flatter than where it is at the moment. Ryan, what about euro sterling?
Yeah, another one to get yourself out the volatility, get yourself out the noise. And I think this is one I trade a lot. I'm sitting on the long side for a more longer term trade. But again, play between the ranges. We got a level down at 88. We got a level down at 89. We can't seem to get through and hold moves through those two levels. So if you're looking for something less panicky to trade, let's call it that, euro sterling is one to look at. I'm going to be looking at trading into the 88 level. If you want to push the boat out a little bit, we've got a zone just below, down towards that sort of 87, 70s, down to 50s, bit of a support zone buffer there. So, if we do get a break, that's a sort of extension you could stretch to. Below that, a break of that, then it could be the low 87s and the trade might be a bit of a bust, at least in the short term. On the top side, as I say, we get to this 89, we struggle, we get above 89, 20, 25 seems to be the extension up there. We hit that, can't get through, down we come again. So as I say, mainly this is again a low volatility currency to trade. I think it's got like a 40 pip range, 45 pip range today, while everything else is going potty. So if you want to get yourself out the noise, just look to sit in this one. We're pretty close, 88.30s at the moment. Look to see if we get a move down to that 88 handle and look for longs off of that. Conversely, look for the shorts off the top side into the 89s.
Yeah, definitely. The other thing, of course, is we've got the budget. in the UK this week. But I don't know about you, I'm not expecting any massive policy announcements or game changers from that. And I think sterling should probably shrug it off, shouldn't it?
Yeah, it's likely to. You know, everyone's going to be looking at the tax implications. Are they going to ease taxes? That's going to be a positive for the pound, or do they tighten them up a bit more? That might be a little negative, but I'm not expecting anything that's going to materially change this. In fact, it could give you the edges of the range that will enable you to get into a trade.
Yeah, most definitely. Well, with that said and done, that brings us to the end of another show, I should say. Thank you, as always, for watching. I get the feeling this is going to be an incredibly long week, and I'm already looking forward to having a beer on Friday afternoon once it's over, and then a long lie down in a very, very dark room. As always, thank you to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me and helping to make some sense of the mess that is going on in the markets at the moment. Thank you also to Kyriakos, our producer, for, as always, bringing this show together and making it look as smooth as it does. All three of us will be back this time next week. In the meantime, let us know in the comments below how you're trading the markets, what you think of the show, and if there's anything you'd like us to discuss next week. And we will see you then. Thanks as always for watching, and goodbye for now.